Good afternoon, maybe good morning, depending on where you're listening to us from today. But wanted to welcome everyone to our today's live webinar. We have a guest host, or a guest presenter, I should say, joining us today on. And the topic we're going to focus on is how to buy and sell mortgage notes. And our guest presenter today has a lot of expertise, a lot of experience in that particular industry, and is also the CEO of a company that is kind of specialized in doing that. So we're going to have him share that information with us here in just a little bit. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company for a number of years now. I'm also a licensed attorney, although I don't do any legal work for Advanta or any of Advanta's clients. Per se, my contact information is here on this slide. So if you'd like to reach out to me with questions about a self-directed IRA or using retirement funds to invest in notes and mortgages, please jot that number down, jot my email down. I'm more than happy to reach out to you there. Just a little bit of legal disclaimer that we like to put out there, just to keep in mind that the information that we provide is for educational purposes only. We do not do any due diligence. We don't on any investments. Even the guest speakers we have come in from time to time, you're encouraged to do your own due diligence on them as well. Because we can certainly give you some legal, tax, and investment information, but as far as making a decision for you or helping you reach that decision, that's what we do not get into that area of giving advice. About Advanta, if you're not familiar with our company, we have over $1 billion in assets under management. The only thing we do at Advanta is hold self-directed IRA funds. I'm sure many of you on the call are already familiar with that. That's why you're in our database probably and on the call. Just our differentials, we really focus a lot on the educational aspect of today's really educating our clients and our prospects so they're well informed when they're making investments and know what they're getting into. So we do a lot of educational events. Today's event is just simply another extension of that. And we do it from a personal standpoint with individuals who become account holders. We offer you a concierge level service where you're assigned to one account manager, one point of contact in our office for anything that you need regarding your accounts. We feel that really gives our clients a much better experience when it comes to their self-directed IRA account, their assets, and you don't have to call an 800 number each time you need a question answered. We do have offices in both Florida and the Tampa Bay area, and also in Atlanta and Georgia. But we work with people all over the country, so it doesn't matter where you're located. We can certainly work with you. It's not a state thing. The IRAs are a federal creation, a federal entity, so we can work with anyone and have worked with many people across the entire country regarding their self-directed IRA needs. As I mentioned, we really focus a lot on the educational aspect. That's either in the form of a live lunch and learn seminar, either at our office in Tampa or our office in Atlanta, or online webinars, such as the training that you're participating in today. If you obviously, people who are listening live to this call, you're going to get the benefit of that live interaction with myself and our guest panelists today. But if you ever want to go back and re-listen to it, today's class, or just look at other events we've had, good or on-demand YouTube page, you can find that on our website at advantaira.com/learning center. And get links to all of the past webinars that we've hosted as well. Just very quickly wanted to touch on a basic. If anyone on this call has not heard of a self-directed IRA, or maybe it's wondering why I only recently heard about it, it's because most IRA accounts that are out there are administered by banks, brokerage firms who are offering you only the products that they sell as an investment option. They're not willing for you to hold a note or a mortgage or maybe an interest in a private fund inside of your IRA account, because that's not their business model. Their business model is to sell publicly traded assets. So the reason you haven't heard of it is because they're not going to advertise investments that they don't hold. Similarly, at Advanta, if you look at our marketing material, we do not advertise about buying and selling mutual funds and stocks because we're not a broker-dealer. We talk about alternative assets like the topic we're talking today, and obviously many more as well. The IRS regulations allow for a very, very broad range of investment activity and options. It is up to each individual custodian to decide what they are willing to hold. That's where, again, the differentiator that we have is that we will hold these truly alternative assets. So we do so in a number of different types of accounts. So if you're considering self-directed, we're wondering what monies out there could be used for a self-directed type investment. Any type of IRA account, traditional Roth, a SEP, or a simple accounts, they can all be self-directed. So if your account statement has a designation of IRA on it, that is money that could be used through our services and our self-directed platform. If you're a sole proprietor and you own your own business, you could have access to an individual or solo 401k account. We also do health and education savings accounts. But another big area where people miss when they hear self-directed IRA, they think, well, I don't have an IRA. I really only have this old 401k plan or maybe an old defined benefit plan. Those plans, when you no longer work for those companies, can also be rolled over into a self-directed plan as well. And then once the money is in the account, it's up to you to tell us what it is that you want to invest in. It could be anything related mostly to real estate. Is what we see at Advanta. Probably 70–75% of the assets we hold at Advanta are real estate related, whether that's actual dirt and single-family properties, whether that's long-term or short-term rentals, or just maybe for rehab. People investing in condos, mobile homes, tax deeds, private REITs. We've seen a big uptick lately in the multifamily space as well, in the form of real estate syndications that are put together. So really, if it's any type, the only thing you can't do with the real estate is it can't be a property that you want to live in or that you want to vacation in or use. If it's purely an investment property, that can be held inside of a self-directed IRA. Related to that, though, the other thing we see a lot of, and again, that's what today's webinar really is mostly about, we see a lot of private lending, and a lot of that is tied to real estate. You're allowed to loan money from your IRA to any third party. You can do so without any type of collateral. That would just be an unsecured promissory note. But most of the investments we see are collateralized. So there's a mortgage, there's a piece of real estate that is acting as kind of the collateral for that particular private loan. And those loans take a variety of different terms. It could be just a traditional mortgage loan, 5, 15, 30 years. Could be some short-term transactional funding. We've seen deals in short of just a few months. An IRA providing just a very simple short-term loan. You could structure your loan with equity participation terms. If you're having an investment with somebody who's maybe rehabbing a house, your loan to them from your IRA account could be structured not as a return simply of interest, but maybe a portion of profits that are made on that particular deal. We've seen a number of notes and mortgages structured in that capacity as well, where the payoff of the loan includes a percentage of profits or income that the other party and the borrower has actually received from their investment. And certainly you can collateralize assets, collateralize your note with other types of assets, whether that's farm equipment, automobiles, livestock. Again, the consideration when you're doing private loans from your IRA is that you have to be your IRA has to be lending money to someone who is not related to you, who's not a disqualified person, and I can certainly answer questions about that if anyone has more as we go along today. But that's really the one main restriction with the types of private lending. When you get into making loans from your IRA, it's up to you, and then maybe not all the time, depending on the type of investment you're making, but if you're establishing a brand new note, all those terms that go into creating a promissory note and mortgage, the amount that you're willing to lend from your IRA, the interest rate, what the length of that loan term is, the amortization or prepayment penalties, all of these terms that go into that note are really a negotiation between you and your borrower. So you sit in the banker's seat and decide, what you're willing to accept as far as the terms for the loan that you're going to make inside of your IRA account. So just one of those, we do a webinar, we go more in depth in this topic. You can view it on our YouTube page. It's called Be the Bank or Private Lending with Your IRA Account, where we do a deeper dive on the IRA side of things. But today's webinar really is about the guest presenter that we're bringing on today. I would encourage anyone as we go through the presentation today, if you have any questions for myself or for our guest, Rick, please type them into the question box on the screen. I'll be monitoring those as we go along. But certainly we're going to bring Rick on in just a minute. I just remember the benefits of private lending as you listen to what Rick says and things I've already mentioned as well. Again, you're acting as the bank with your IRA account, determining those terms setting the rate at which your IRA is growing. I know for many individuals as well, a loan has less liability than owning actual real estate inside of your IRA account. Some people who are concerned with the liability aspect, if you say it's much easier to simply be a lender on the property than it is to be the actual owner. And likewise, it can be a very low maintenance asset. So if you're the lender on a real estate deal, all you're waiting for is your monthly payments to come back in and be deposited back into your IRA account, as opposed to dealing with the toilets and the tenants and those issues, which again, some people that's fine with them and they're really more than willing to do that. But for others who want a more passive investment activity, I think private lending really gives you that option. So at this time, I want to bring on our panelist, our guest presenter, Rick. Rick, are you there?
Yes, I am. Thanks, Scott, for
All right.
having me. I really
All right,
appreciate
Rick, no problem, Rick. I'm going to change over the controls over here and let you take over. I've changed you as a presenter so you can share your slides with us. I'll let you know when those up. There they are. They've come right up. So, and I just encourage anyone as we go along the event today, just any questions you have, get those typed into the question box on your screen. But Rick Allen, he's been an active investor for over 15 years. He's participated in the purchases of over 400 houses and 300 loans. Currently, he runs a multi-million-dollar note portfolio called the MWM Fund, and he's also the CEO of a mortgage note technology platform called PaperStack. And so he's going to talk to us today about buying and selling notes and mortgages, and we'll share a little bit about PaperStack as well, and that technology platform he has. So Rick, at this point, I'll turn the presentation over to you.
Great, thank you. Yes, as Scott mentioned, I've been investing in distressed assets for the past, I guess, 15, 16 years. I really got started in real estate, just, kind of dipping my toes into the water, learning about the distressed asset and the private lending side. And in, I guess, between 2008 and the end of 11, I did about 400 houses with my partners. We were in and out. Really, it was really a nice time in the industry. Assets were cheap. And then in 2012, I've heard of mortgage notes at the time, but unbeknownst to me, you could buy them just, as an individual investor. And I tell people I accidentally bought my first note. It was a frame duplex in Winter Garden, Florida. The debt on it was, the unpaid principal balance was 95,000, and we paid $8,400 for it. We were in and out of the asset in 14 days, sold it for 38,000, and that was kind of the tipping point for us. My partner and I looked at each other and said, "Wow, that was fantastic. Let's do that again." So that's kind of the start of my journey, as Scott mentioned. We do run a fund right now called the MWM Fund, Money with Meaning Fund, and it's targeting, it's a Regulation A+ fund. Anybody can invest in it. You don't have to be accredited. You can start with as little as $200. You can do it once, you can do it repeating, and we're paying up to a 10% return. We're really focused on investing in notes, though we do diversify and we're able to buy within the fund other asset classes, commercial debt, or anything really touched by real estate. And then PaperStack, of course, is an online trading platform where you can go find assets, source them, look at them. So happy to show you guys that. But I guess today, really what we want to focus at is why buying the real estate backed notes. And, we'll touch a little bit on where to get them, stuff like that, but really the reasoning behind it. So why notes? Well, the reason I love them is because they're lower risk and they're high yield. Well, how does that really work out? Typically, those things don't go hand in hand. They wind up, they're like the Tooth Fairy, Easter Bunny, Santa Claus. It's like, do they exist? Yeah, they actually do. And they exist in the note space. One of the things that makes them extremely low risk is that they're secured by real estate. At the end of the day, if you're buying a loan, you really want to know that it's backed by something tangible. There's a bunch of other investments out there that can be speculative, that you really don't know, like, well, what is this actually backed by? I don't know, Bitcoin for one of them. I don't understand that. Not to say it's a bad thing, but just looking at that, So yeah, that's one of the great things about mortgage notes is they're kind of risk adverse because they are secured by real estate and they're insured. So you not only have, hazard insurance if the house burns down, but you've also got title insurance. So if there's a cloud on title, typically the insurance policy travels with the loan when it's assigned. So that's a huge benefit, So whenever you're buying a loan, essentially what's happening is you're buying the collateral file. So somebody goes out, they want to buy a house, they don't have the cash. What's going to happen is the bank is going to originate a mortgage and they're going to originate a note. So the note is the IOU. That's basically, it outlines the terms, interest rate, the total principal balance. It'll say who you owe the money to. That's the IOU. The mortgage, that's what collateralizes the house. So if you stop paying on the IOU, the mortgage is what's going to say, look, these are the repercussions of you not paying. And so some people don't understand that. And you really need to understand that the property is collateralized by the mortgage. The property is the collateral for the note. The mortgage and the note are two separate documents. A lot of people don't know that. And both of them have transfer documents that go with it. But that's really what secures it to the real estate. And there's different types. You can buy performing loans, and whenever you buy a performing loan, it's a security investment. This one here, you can run case studies. It's an $80,000 house performing note that you can buy at a huge discount of $42,766. I mean, that's just one example. And you're probably thinking like, well, why would somebody sell something that's performing at such a deep discount? A lot of times these the assets that we're seeing right now, they were non-performing at once. So somebody is buying them maybe for 20 grand. They're putting some time and effort into getting the asset performing again, and they can go ahead, turn around, and resell the note at 42,000 to somebody who wants to put that into their self-directed IRA account, and they want to have a bit of a passive income. So that's some of the reasons why somebody would be, or how they're able to buy something at 42,000. Let's say they're paying, $433, and they're going to do it for the next 18 years. You're looking at a 10.6% secured annualized return. I don't know where you're getting that right now. That's something that's secured by tangible real estate and you're buying it at a discount. Now, we were talking about the non-performing loan. This person may have bought this same house for 28,000, put the work in, and they can turn around and sell it as a reperforming loan, or they might do something else. They might acquire it. Here they would acquire the property, or they could do the loan modification. So the non-performing loan side really has a couple different exit strategies that people are focusing on. If you're wanting to buy non-performing loans, you have really two thoughts in mind. You want to acquire the property at a deep discount. So if you could buy an $80,000 property for 28,000 and change, once you figure in, foreclosure cost, who doesn't want to buy that? Those are like 2012 prices. Or you may do the loan modification, keep the people in their house, which is a great option, by the way. There's when you can really work with a borrower and keep them in the house, that's kind of our mentality in our fund. It's money with meaning, is we want to try to preserve home ownership. A lot of times there's families attached to these houses and they have children. And if you can go in and do something nice for them, maybe put the payments in the rears, stack it on the back of the loan, stuff like that, you're not only giving yourself a great return, but you're doing some social good there. So that's some things to kind of think about. So definitely.
Rick, if I can interrupt, just a quick question, kind of in your strategy in doing that. How often are you able to keep? Do you have a percentage kind of on how often you're able to keep somebody in that in their home?
Yeah, absolutely. We're finding that we target our houses, right? So if we're going to go and we know that our goal is to keep somebody in the house, we don't buy vacant homes, right? Or we don't buy loans that have vacant houses attached to it. We typically don't buy houses where the borrowers are deceased because it goes against our mission of what we're trying to do. So we're targeting the houses, they're owner occupied. Maybe you're anywhere from 6 months to 4 or 5 years behind on their payments. And we're seeing success rates of 75, 80%. The thing that you notice is once you get into the business and you start talking to people, you ask a very simple question. Do you want to keep your house? And remarkably, yeah, everybody wants to keep their house. It's their home. If there's equity in the house, great, but most all of them have emotional equity, something that's tying them to their house. Maybe it's where their kids were raised, maybe it's where they were raised and it got passed down to them and they did a refinance and they got a bad situation. But ultimately, everybody wants to keep their house. And the nice thing about being a private in this industry, a private investor, is you're not bound to a lot of the red tape that some of the larger banks are now. Like Scott would do. I'm not giving legal advice. Please go talk to somebody. But we found on our end that we're able to reach out, and we use a non-for-profit to reach out to our borrowers. But if you're able to treat them like people, most of them want to keep their house and they want to start feeling good about themselves by paying their mortgage. They just had some sort of hiccup along the way, got too far behind, and for whatever reason, the big institutions couldn't work with them. So we're seeing, that's kind of a long answer to it. We're seeing a pretty high success rate.
Good, yeah, and again, thanks for the answer. Just go ahead and continue on. Just again, anyone has any questions as we go through, please type them into the question box. I'll make sure we get them asked.
Yeah, great. Perfect. So so it's secured by real estate. We love that. And one of the things you kind of touch on is this creates income, and it starts that generational wealth. We have investors coming in here that are looking for just the monthly passive income. They want that mailbox money. Another great thing about this is you may get a loan, you're into it for 42, they may owe you 80,000. With the climate or the economic climate right now, the real estate market is very strong. So we're seeing a lot of people refinance, loan interest rates are fairly low. And actually we see some loosening in the regulations on, I know I just read today that the CBPR is removing the debt to income on mortgage side. So with the loosening, people are going to start refinancing. It's going to continue to drive the market for a little bit, I feel. But we're seeing lump sum payouts. So people are just refinancing. If they owe you 80,000, we've had stuff that we purchased it at as a non-performer, turned it performing, and 6 months later they did either a refinance or they went ahead and they sold the property. And so we got paid a huge chunk of money right away. Love when that happens, redeploy the capital. And then people are using this to, if you're buying non-performing and you're buying them vacant, people are using this as a way to stay ahead of the real estate curve and start buying and keep buying these at a deep discount. As we touched on, the real estate market is booming. So it's pretty competitive when something hits the market and it's undervalued. This is sort of that backdoor way in, and that's how I got started. I didn't buy it to keep people in their homes. That was sort of an ancillary thing that happened later. I realized that we're doing well and doing good, both profit and purpose. So, but we got into it to get the real estate cheaper, and it's a viable option for some investors out there.
Hey, Rick, just had a quick question. Again, you mentioned in the last thing you were talking about, you mentioned CDPR. Someone want to know what CDPR stood for.
So they are the, oh my goodness, of course you would ask me that right now. And it's it's one of those things that just escaped my head, but it's essentially they're the regulation that monitors, the lending guidelines, stuff along those lines. It's a government, and actually it's not a government entity. It's just it's been appointed by some people here, but they're basically the ones who are monitoring the lenders out there, making sure the consumer protection. There we go. Started to come back to me. The Bureau for Consumer Protection. They're basically protecting the consumers. They've had some pretty strict guidelines on what's going on in the industry as far as like how much you can lend to somebody. You can't have a certain amount of debt to income when you're buying a house. and they're actually removing that, which is going to start loosening the lending guidelines. As you loosen up lending guidelines, we're going to touch on in a little bit, you'll see that more debt's going to start hitting the street, and there's more opportunity out there for people. So yeah, that's in a nutshell, that's what it is.
Yeah, I had a couple other questions. I mean, we can hold these too. So people just wonder how do you do due diligence on an asset in another state? If this is something we're going to touch on, can certainly address it then.
You know what, we're not going to do a deep dive on that. Like I can sit here and, I mean, we could spend, 3-day courses on this stuff, and there are 3-day courses. I can go high level. Some of the things you want to do is you want to obviously, Google is your friend. At the very core, the first thing I do is I Google something or an address, because I want to know, what does this house look like? And I want to see what the neighborhood looks like, and I'll do a Google Earth drive-by. These are just my high level first thing I'm going to do, run Google on it. There's something out there called bestplaces.net. It allows you to check population density, crime rates, stuff like that. And that all comes into figuring out what your risk tolerance as an investor. My risk tolerance as an investor was fairly high, because we were buying in really, really distressed neighborhoods back in 2005 through, really through 2011. And I just got very comfortable with those neighborhoods. Not saying that I don't buy in very, very, affluent upscale neighborhoods, but it's kind of all over the place. So people use best places to kind of establish what's like a crime rating, and that seems to be people's risk tolerance meter. But also you want to, you're doing valuations. So there's valuation companies. PaperStack, we're actually launching a due diligence platform that will allow people to jump on there and start ordering, broker price opinions, or which is a BPO, and that's just a real estate agent's opinion on value. So they'll do a drive-by in the property, shoot a picture, give you the comps in the area, active, pending, sold, send it back to you. You can order title reports from there, and these are all things that are like the core of buying a note. I would tell anybody out there, don't do it the way I did it. And learn from my mistakes, which was I jumped in feet first. I was much younger and willing to risk. And I guess at the end of the day, it was an $8,400 investment. It's not like I was betting $1 million on something. But get some education is the long term. Is you need to educate yourself. There's a lot of people out there, and I'll give you a couple educators here at the end to touch on, but they will really teach you the recipe and give you okay, here's the step-by-step approach. Because a lot of note investors we see are like engineers or attorneys, and they want like, okay, what's the steps? Show me the steps. I can go ahead and finish the rest. So, and we'll touch on that. You'll learn about here, like, for instance, servicing companies, since that's on our screen. These are people, when I got into the business, we didn't use a servicer to start with, we self-serviced. And what a servicing company does is they're the ones who will go ahead and be the layer between the investor on the loan and the borrower on the loan. So the servicer will go ahead and they'll reach out to the borrower. You give them your direction on what you want them to do and what you want them to offer and how you want them to handle the loan. They'll keep you in compliance. They receive the payments. They keep the logbook on the payments that are coming in. And then it's $15 a month per loan. It's well worth it to put a professional in there, especially if you plan on scaling. If you plan on doing more than a handful of loans, I would say if you're going to do one loan, I would hire a professional servicer. And there's, FCI is one of them. FCI servicing they service 12 billion right now, and they're just focused on the small retail, mom and pop, the one-off, two-off investors, all the way up to some really institutional clients. But they're one of the few out there that are really good, $15 a loan, and they'll keep you in compliance and they'll do all the headaches of it. And then the nice thing is they send you money. You get your mailbox money, which is great. borrower sends them money, they take their $15 and then they send it to you. We call it mailbox money. The nice thing about owning a loan, there's no tenants, there's no management, no headaches. You don't have somebody calling you to fix the toilets and the sinks in the middle of the night. That's good. And the nice thing about notes is it's approved for tax sheltered accounts like your IRAs and your 401k. So it dovetails nice, obviously, into this. Let's say you invested $28,000 in a non-performing note. You're entitled to all the unpaid balances, the arrearage, any penalties that transfers over in the loan. That is great. You could do a short payoff. One of the pivotal moments for us when we moved from just trying to take the house back to trying to work with the borrowers was when we actually did something just like this. We were into a loan for, it was actually 35 grand, and the house was worth around 70. A lady had passed away. The husband was still there. We were working with the daughter. We said, look, give us 55,000 and you can keep the house. They owed probably 90 on the house, but they were so happy. And we were happy because we just got our money back plus a huge chunk of money, and we were able to redeploy it. And it took us, 90 days of owning the loan. So those are some of the nice things about this. But there's other scenarios too. You can go ahead and vest that same 28,000. You're still getting all the unpaid balance, the arrears and the penalties, and you can do a deed in lieu of foreclosure, or you could do a foreclosure, one of the two. And this is just to get the house back. We use this technique on loan. There was a loan sitting on paper stack. It was actually a contract for deed, which is kind of just a little bit different debt type. But it was 35,000 was what they were asking for it. They hadn't made payments in several years. Principal balance on it was not, or the total payoff wasn't much higher. It was like 42,000. But the house itself was worth 185 fixed up. This was in Georgia. And that loan just sat there, and I was like, wow, this is crazy. Somebody's got to buy this. So we looked at it and ended up purchasing the asset and reached out to the borrower, and they went cold, they were dark, they wouldn't respond. And we shot them a text message, and they wound up responding saying, yeah, I was going to sign the house over to the last person that owned my loan, but I didn't really care for the attorney they were using, and so I just stopped talking to them. We gave them $3,000. They signed the house over, sold the loan sold the house within 90 days for $95,000. We were into the loan by that time, probably 40 grand, and it was just 90 days. So getting the house back is definitely an option that we take advantage of. That's the great thing about loans. Buying mortgage notes, you have multiple exit strategies. You're not tied to one exit strategy. You can have a plan A, a plan B, a plan C, and they all pretty much work out for you. So, I mean, this instance, you could own this 60,000 as is house for 28 grand. You're in a really nice equity position at that point. So, people, you go out there, you purchase notes. Where can you get notes? You can get them from note brokers. And you're going to see now coming from these brokers, there's this third wave of post-recession distressed debt. DS News Magazine, it's an industry sort of publication. They're saying there's a third wave of inventory coming. At any given time, while the market is strong, the real estate market, there's about $300 billion in scratch and dent loans that are being traded out there. 300 billion. When the market is strong, when the market tanks, that number easily goes up to 900 or $1 trillion, which is just, that's just crazy. That's huge opportunity. So you never want to wish a recession on our country, but if it does, it's nice to know that, wow, if I'm transitioning my investment to something else, I know where I'm putting it. I'm putting it into debt, because when there's more inventory, prices come way down. You start buying stuff at 10, 15, 20 cents on the dollar, just because people need to liquidate it. Sort of that first wave of so there's three waves. The first wave was the risky loans. That was the stuff that was made from 2004 through 2008. That was if you could fog a mirror, you could get a loan. type of debt. And we saw a lot of those, you saw, bartenders and servers owning 6 houses at a time. I knew there was bellhops that had 10 loans going. So that was the first wave of stuff that hit. Then there's, the 2018 hurricane related stuff. And, kind of in between there's like there's a 1.5 wave or a 2.5 wave. And that is, there are still loans that were originated from like 2013 to 14, 15 that we're seeing some delinquencies there. And the reason is just stuff happens. Life happens. There's always been and there always will be, delinquent debt. But also I think that there's been a bit of a desensitization to foreclosure in our country, to where people are like, hey, my neighbor, he went through a foreclosure, during the recession, and he's okay. He bought a house again. So that's something to keep in mind. But the third wave that they're talking about, these are the government insured loans. And there's privately held loans as well. So within the past, 2-3 years, there's been an uptick in the third wave. Overall, there's only been a 1% increase in the government insured loans, but the VA backed loans have had a 31% increase. And the FHA backed loans, they've gone up 17%. But something that's pretty staggering is the private portfolio loans. National lenders increased by 3%. But private loans owned by the mid-market lenders, so these are maybe some private, family office loans, that's up 139%. So some of those guidelines are not as strict as you would at the institutional level, and you're starting to see upticks in delinquencies there. Even Black Knight, who is a huge, they provide loan servicing software, amongst other things. They're kind of like one of the largest players in the industry. They're always monitoring mortgage data and seeing what's going on and paying attention to the trends. Are reporting in September of last year that the delinquency rate for 6 months after origination is starting to tick up. So those are just all like sort of indicators that point to influx and inventory. So, obviously let's talk about how are you going to find and purchase notes. So touching on PaperStack a little bit, we've taken the process of buying and selling a loan, which prior to PaperStack was completely a was completely a manual process. It was done through email, through spreadsheets. It was tough to locate inventory. So we've got a marketplace on PaperStack where buyers and sellers can go conduct business. We've got a bunch of different sellers on there. The inventory is always changing. It's free to sign up. You can go on there and just start shopping. And if you're in the process of learning about notes, it's a great place to go find assets to look at, run numbers on, and start doing your due diligence, because that's always the key. Do the do. You got to do the due diligence. We have individual note sellers on there, up to institutional guys that are buying and selling billions each year. They just will liquidate stuff into the retail market that their other institutional investors aren't buying. Not saying they're bad loans. A lot of the institutional capital out there, they just want to focus on the stuff that's 250 million or 250,000 in value or higher. There's a huge opportunity at the smaller balance stuff. And the nice thing about that is it takes less capital to get in there. So assets worth 75,000. The great thing is you can put somebody into those and put them, you can owner finance it for them, or you can get in there and you can take the house back and rent it. And, rents are going up astronomically high. It's not uncommon to see $1,300 or $1,400 in rent coming in on an asset that you're into it for 55 or 60,000. It's a little bit, if you take the house back and that's your play, great. We try not to take the house back and stay on the debt side, but it's always nice to have that option. So you can go on PaperStack, start looking at that stuff. And the nice thing about it is we've got an automated process, so you can buy your very first loan and not miss a step along the way in the purchase process. had several first-time note buyers come on there and do a trade. That's what's called when you buy a loan, do a trade with somebody who has been in the industry for 30 years. And they're able to do that because we've got the automated process and it makes it very easy. So, you know, what's going on? So this is, you know, one of the houses that's rolled through paper stack. The BPO or the valuation was $50,000 on it. It's a 3-bedroom, 1-bath, 43 payments had been made already, right? It was sold in 2012 with seller financing. They did 750 down. So there was a note of 53,000. When you do some seller financing, you can actually sell assets at a premium, a little bit up or higher than value. Not a lot, just a little bit, because you're able to give somebody a loan who is unbankable. Maybe they're self-employed, maybe they had a ding on their credit, but they can buy this house and they can start making payments on it and they can start building their credit. So the seller finance note at the end of the day was 52,000. There was 209 payments remaining at a 9.9% interest rate. That's $504 a month. That's great. So all of that amounts to if you buy it for $23,400, which these are real numbers that are taking place on the platform right now, that's a 47% investment to value. So you're buying an asset at $23,000, it's performing, it's kicking off $504 a month in payments. Some people will just say, you know what, I'll take that all day, I'll put that in my self-directed, set it, forget it, and be a passive investor. That's a 25% yield. What if you paid $30,000? You'd still be pretty happy, right? So your passive investor choices. You know, one of the things about the self-directed IRA space, and Scott could correct me if I'm wrong, but you kind of have to be in that passive role. We're not swinging hammers. We're not doing a lot of borrower outreach. We're leaning on our servicers we have in place to do that, which is a great thing about notes. You don't have to swing hammers. You can give some direction. They do the work. So your passive choices are, you do the stock market, bonds, cash-like investments, rental properties are some of the other ones. Become a private lender, that's another one I see. Not bad, you're in the note space, private lender, but the problem with that is your money goes out and then it comes right back in and you got to get it out again. So you have a lot of idle time, or what I like to call dead money. Or if you're a private lender, you've got these interest payments coming in. Well, what do you do with that? It'd be nice if you could buy a loan with that, but typically if it's $1,000 a month, that's not going to buy you a loan that you're interested in. Or you can start buying 2 to 5 year performing income streams. So what does that exactly mean? So let's look at this house. This is what's called, it's a fairly technical play. It's called buying or selling a partial. So you don't actually have to buy the entire loan every time. You can buy a portion of the loan. So I might buy the next, I don't know, 50 or 60 payments. Let's take a look at what that looks like. So in this particular case study, there was a portion of payments that were already made. The value of the house is $130,000. It was a 30-year mortgage, so there's 360 payments. So you might say, okay, I'm going to purchase the next 60 payments. So that's 5 years worth of payments. You pay $42,000 for the next 60 payments of $880 a month. You're getting a 9% annualized return, and it's backed by property that's worth 3 times what you paid for it. So when you talk about secure real estate or secured by real estate, this is a great play. We see this happening all the time in the with the self-directed space, but we're actually also seeing it on the other side of the equation, where somebody is buying a non-performing loan. They work it out with the borrower to get them paying again. And if you're buying, you know, say you bought this loan for $40,000 and it was non-performing, you restructured the loan, you got it paying again, and it's paying $880 a month, and you sold the next 60 payments for $42,400. Well, in 5 years, this is coming back to you, and you're not going to have any money into it. there's some certain guidelines you have to hit or metrics you got to hit according to the IRS. And I would say, disclose. I'm not going to tell you. I think it's $100, but go get some advice on that. Scott could definitely point you in the right direction. But there's a lot of investors I'm seeing out there doing stuff like this. So you're buying 2 to 5 year performing income streams, and you're doing it to just have it secured by real estate. You can do it from anywhere that's got an internet connection. It can be done. You can analyze the deal in 20 minutes or less. You can be verified, have the house verified by third parties, so it's a good asset. You can even lean on educators who will tell you, hey, this is a great asset or it's not. You don't have to travel and go look at the house. And you start receiving the payments with a servicer in place. So there's other options out there. Like I said,
Rick, if I can interrupt you, because somebody actually just asked about that last example you were showing. So do those types of investments have to be done within a self-directed IRA, or can you be done outside? I'm assuming there's no reason they can't do that outside of an IRA with cash.
Oh, of course, you can do those outside of, we see a lot of people doing inside the IRA and outside the IRA. Obviously, for me, I like the tax sheltered approach, but you don't have to do that. You can do them outside the IRA all day, every day.
Okay. Yeah, go ahead. We have a couple other questions. I'm going to save maybe some of these for the end, but yeah, keep going.
Okay. So one of the things we put together was this money with meaning fund, the Regulation A+ fund. Like I said, it's for accredited, non-accredited. It's really low requirement. You can invest $200 or more. We're paying up to 10% returns, and it's completely passive. The benefit to you is there's a couple of them. If you're interested in investing in notes and you're like, look, I want to get started now and learn as I go, then you can do that. You can go ahead, you can have actually your money paired up with other people's money, which diversifies it. So you're not tying it to the success of one asset, but it's spread amongst all the assets within the fund, which is great. It's completely passive. And also, we're seeing a lot of people coming in with, we've kind of called it the dead money. So maybe you go out, you buy a rental property. And again, I have nothing against rentals. I have some. But when those rent payments are coming into your self-directed retirement account, they're kind of just sitting there, and they become a little bit dead unless you're really active. So the nice thing people are able to do is like, look, I'm getting $800 a month coming in, and I'm waiting to build up enough capital to buy another rental. It's great that you can go and deposit that money. You can have monthly withdrawals come out and have that money go right into the money with meaning fund, earn up to 10% until you acquire enough capital to go ahead and buy another rental or whatever your investment choice is. We don't have a lock period in the fund. And we have a best efforts clause that says, look, we'll go ahead, if you call your capital, we'll do everything in our power to get the capital out. We haven't had an incident where we weren't able to do that yet. So that's a great thing. So those are some of the benefits to the fund. I touched a little bit on note education. This is somebody, he actually taught me pretty much everything I know in the industry. He worked for a company called Note School. Note School's another good one out there. But Kevin Shortell is kind of the guy who taught me what I know about notes. He's been in it for 30 years. He's a podcaster. So, Note Educator of the Year. I recommend checking him out. That's my shameless plug for somebody that I know that I'm comfortable giving my stamp of approval on. And, best-selling author. So it's just something I recommend. I said at the beginning, you need to educate yourself. There's other educators out there. Google is your friend, YouTube is your friend, but you really need to get some education before you start deploying capital, because there are some nuances. It's tied very closely to real estate. It's secured by real estate. Certainly having a real estate background and knowing how to evaluate real estate is great, but you do need to have some education so you're avoiding some of the pitfalls. So If you have any other questions, please, I'm happy to answer what we have right now. I think we have, around 10 minutes to go that I can answer questions. But if you'd like to reach out to us at PaperStack, it's hello@paperstack.com, or you can get me at rick@paperstack.com, and I'm happy to, answer questions. I like to give back. I do think investing in notes is such a great investment class. You know, there's so many layers to it that we couldn't possibly scratch the surface today, other than tell you like why is it good and some of the benefits of it. I can certainly dive deeper with sometime in the future if there's a desire, and actually start working on due diligence and evaluating assets and stuff like that. But I really appreciate it, and I'll kind of open it up to Scott to take it from here. If there's any other questions that people have, I'm happy to answer them.
Yeah, Rick, thanks. The great presentation. We have a number of questions here. So when we start out with kind of a more basic one or easier one to go over, what came in earlier. I guess this would be either the non-performing or the performing notes. The question was, is it a bank or a homeowner that sells the note? Now, it wouldn't be the homeowner because they're the one that they don't own the note, they only own the property. But where are you typically getting those notes, even for your platform on PaperStack? Is it buying directly from the banks?
No, so typically the banks are selling off in, just a quick high level, what will happen, the waterfall of how the loans filter down to the retail market is Bank of America, Chase, pick your poison. They'll take a portfolio of assets that are non-performing or scratch and dents or stuff that they just need to move off the books, and they'll package them up into a pool of like $500 million. And they will sell those off to a large fund like maybe Blackstone. And Blackstone will take the cream of the crop off the top, like I said, stuff worth 250,000 or more. And then they'll break up the rest of the pool into $50 million pools or $100 million pools or $25 million pools. And they'll start liquidating to some of the smaller players out there, like a Condor Capital, a Bayview, Angelo Gordon, Oak Harbor. There's a bunch of them, right? And so those guys now have these $50 million pools, and $250 million is really kind of a small player in the game. It's not huge, but they'll work the assets and then they'll sell the assets. They're not bad assets. A lot of times, Blackstone is going to sell them for less than they paid for them, and a lot of the guys in the industry who have 250 million are overcapitalized and understaffed. So they're looking to make, $500 on a loan. If they can make $500 on a loan and they're doing volume, they'll sell that down into the retail market. So we're dealing with guys who are trading, I've got guys on the platform who are trading $5 million a year. Some people that are selling, 5 or 10 loans a year. And then we've got some guys that are trading $1 billion a year. So it's but we're not getting directly from banks at this point. We're working on an enterprise level product that will help those bank transactions go. And when that happens, there's going to be the loans that get kicked out that are going to filter down pretty quickly into the retail market. So you'll start seeing that stuff, but we're probably a good 9 to 12 months out from that happening. But there's plenty of inventory right now. I'm not really concerned about that.
Two questions from one individual came kind of talking about risk is what environmental factors, the economy, different rates are not ideal maybe for investing in notes. And then kind of piggybacking on that is what is the risk in buying these types of loans? Like what can go wrong if you're buying either a performing or non-performing note?
So, environmental risk right now, just talk economic stuff. We've been purchasing since 2012 when things were pretty dismal still. The real estate market was very weak. Starting to see the uptick there, and through right now where the real estate market is very strong. As the economy is the stronger the economy, the less obviously delinquent debt is out there. That's just a kind of an understood supply and demand thing. So pricing fluctuates up to, I'd have to look. We did a mid-year market report. Oh, here it is. So, people were still able to buy stuff at 36% on our platform of the value. So $100,000 house, 36,000 was the kind of the average of what's going on. There's several other sort of key metrics in there, but as the market fluctuates, when the market goes, the real estate market weekends, or there's a correction, there's an increase in inventory, pricing comes down. When the market's strong, the prices are a little higher, but the margin is still there, and you're secured by assets that are going up in value. So some of the risks of buying these assets, if you're buying them right, there's not a lot. I would say a potential is, we've had trees fall on houses. It's the same thing as owning real estate. We've had houses get burned to the ground, but they're always secured by, they're always backed by insurance. So we always have insurance in place. If the borrower is performing, typically we have a performing insurance policy there, we're covered. If the borrower is not paying on their loan, we put what's called forced placed insurance, and it's just lender coverage. So we can set how much coverage we would like in the house. So those are, really that's the biggest thing, is damage to the asset. But even if you wind up taking a house back through foreclosure, you can always, sort of what we call it is note your way out. So you may wind up in a situation where, man, I'm gonna have to fix the house up. I am gonna be in it for what it's worth. Well, you can go long on it. You can fix the house up and rent it. You can fix the house up, owner finance it, sell it for a premium, and then sell the loan after, a year. So, those are like the biggest risks are damage to the property. You can have collateral risks in that the paper is not good, but that's sniffed out at the beginning when you're doing your due diligence. So the title report will usually filter that out.
Okay, one question, somebody asked how much capital or access to capital is required, or what do you need? But I think you kind of answered that. Your fund takes as little as a couple $100, and
Yeah.
some of your examples show that only takes maybe 20 or 30 grand if you want for some of the non-performing notes, or even for the stream. When you buy in the set number of payments
Right.
coming in, and so it's really anywhere between, right?
Yeah, there's a lot of different avenues to get into this. You can buy first position loans, you can buy second position loans, you can invest in a fund, you can invest in a partial. There's tons of different opportunity there. So it's, you can get involved with as little as $200. It just depends where you want to go. Obviously, if you're investing in the fund at $200, we're paying up to 10%. You're learning while you're investing, hopefully. You're not hitting that 25 or 28% home run deal, but you're still slow and steady wins the race sometimes. And it's better to get some traction under your feet and get some confidence before you go out there deploying $100,000, $200,000 into a note portfolio.
Quick question. Someone just asked about if they were invested in the fund, what is the length of time if they wanted to withdraw the money from the fund? Is that something that is done fairly quickly, or is there amount of time that the funds need to stay within, their money needs to stay inside the fund?
So right now, we don't have a lockup period. So to do a 10%, if you withdraw your funds within the first 6 months, it's a step up. It's 8% is up to 8% will pay you. 6 to 12 is 9, and then anything after 12 is 10%. We have a best efforts clause on liquidity. So it's in our private placement memorandum, or in our offering circular, which is a tantalizing 85 pages of reading. If somebody would like to do it on our platform, please. I've read it several times. It's not fun reading. It's kind of boring, but it gives you just the breakdowns on the funds. It's the SEC. It's on the SEC website. But we try to get your capital out. If you say, look, I need my capital out this week or next week, we'll do a best efforts clause to go ahead and pay you your capital immediately plus your dividend up to that point.
I'm going to wrap up maybe 2 more questions here, and if anyone else, if you didn't get your question answered, please reach out to Rick. We'll have him give his information here again in a minute. Someone asked, does paper stack the loans you have available there? Do you check if a note is encumbered with other liens, such as a tax lien or IRS lien or anything else that might encumber that note, that investment?
No, so at PaperStack, we don't go do title checks on the loans that come in there. We just implemented, or it's about to be finished this week, a KYC and an AML. So we'll have people's identities as much as possible as far as the users go to keep bad actors off the platform. But the due diligence of finding on tax liens or, and I've purchased several assets that have tax liens. That's not something that really scares me because I just price it into my acquisition cost. But no, we don't check that. That's on the buyer when they go on there. We check it whenever we buy it in our fund. We do a title check, tax check, just to see what's going on with the borrower and to see if there's anything we're competing with. But PaperStack is just providing a marketplace in the digital transaction process. We're providing you the tools to go do it on your own, but we're not doing it for you.
What percentage of the portfolio on average, I don't know if this is maybe the fund or maybe just some of the loans on PaperStack as well, what position or what percentage are second position loans?
So, and we don't buy in our fund, we don't buy second position loans. We buy strictly first, but on PaperStack, let me see if I can see how many are on there. We got 117 listed, and I would say there's probably somewhere in the neighborhood of maybe 25%. I can pull it up, and I don't know if you can still see my screen. I can pull it up real quick.
Yeah, unfortunately, I had changed that.
Yeah, that's fine.
Yeah, 25%. I think that they were just asking for that rough percentage. And then one question, I'm going to do this the last question, and then, like I said, everybody can reach out on how do you give your information again, Rick. But someone know, how is PaperStack funded? Are there fees when a note is bought and sold on paperstack.com?
Yeah, so on PaperStack, we're making 1% from the buyer and 1% from the seller. We had a minimum of $500 fee. It's just a transaction fee. It's for providing, all the, we provide a complete digital timeline. So any transaction you have, you're going to have a digital timeline. You're going to have, you're able to, talk to the seller on the platform, offer them. All your communication takes place there. We provide all FedEx shipping labels, tracking. We're generating contracts, assignments, allonges, transfer docs. Collateral audit is included with that. And then we have the ability, we have escrow baked in. That's actually extra for escrow. But it's 1% from the buyer, 1% from the seller. Just to give you an idea, like I said, we have a minimum of a $500 fee. We have people who are using our platform who are buying $2,000 loans, and they're paying $500 to close it. They're paying $250 for escrow and $250 for the PaperStack fee because it's convenient, it's safe, and it's secure. So it's sort of because somebody gave us like probably one of the better compliments. They said we're like the Apple of note trading platforms, which I was like, wow, that's great. People are willing to pay for it because it's making their life easier.
Great. Rick, thank you very much for your time today. Excellent presentation. I know we have a lot of people on getting a lot of out of it. And so obviously there's some people who will watch this presentation on our YouTube page, just to maybe remind them and remind the people who are still on how to best get a hold of you or PaperStack.
Yeah, like I said, you can go to hello@PaperStack or rick@paperstack.com, fire in questions, comments, just reach out to say hi. I'm on LinkedIn. You can find me there. Actually, I see a couple people have already hit me up on LinkedIn since we've been on this. But yeah, we're happy to hear from people. If you don't get me at hello@PaperStack, you'll get Brett, who is he's like our business development guy. He's one of my co-founders. Great guy. He is super knowledgeable and really likes to help people just feel their way around the site, answer questions. You can even go right on to paperstack.com. It's paperstac.com, no K. And there's a little button at the bottom that you can click on, and it's a bottom right corner, and just immediately just open up a chat. And Brett's pretty quick on that. So lots of different ways to get a hold of us. Happy to talk, and happy to have somebody reach out. And hey, I want to say thank you so much for for having me on. We're happy to come in here and provide a little knowledge. I'm hoping everybody got something out of it.
Absolutely. Like I said, great presentation, Rick. Thank you very much again. Thank you to everybody who listened and was on today or who's listening to the recording. Here's my contact information. There was an IRA question that popped up during the class that I answered just through the chat box. But if you have any other questions on your IRA, how it could be used to invest in notes and mortgages or through PaperStack, just reach out to me. I'm happy to help you get that process started. So again, Rick, thank you very much for coming on today.
Thanks, man. Appreciate it, Scott. Have a good one.
All right, thank you.
Bye.